Most traders mark support and resistance on their charts, then wonder why price blows through these levels like paper. Here's what the professionals know. Without volume confirmation, you're trading blind. When accumulated buying meets resistance at diminishing volume, it telegraphs weakness. When support holds on expanding volume, institutions are stepping in. This is the language of the market, and it speaks before price moves. Watch a stock approach resistance at 50. The crowd sees rejection and sells, but look closer, volume is drying up with each test. The fifth touch comes on half the volume of the first. What does this whisper? Selling pressure is exhausted. When accumulation begins on the next dip with volume surging 3x the average, that's your confirmation. The composite operator is loading the boat, while the public watches from the sidelines. Let me be perfectly clear about something that has separated successful speculators from the casualties of Wall Street for generations. Volume is the language of the composite operator, and if you cannot read this language, you are trading blind. When you observe a stock testing support or resistance, what you're really witnessing is a battle, a war between buying and selling forces. But here's what the untrained eye misses: not all participants in this war carry equal weight. The public trader, the amateur, the emotional speculator, these players move in and out on light volume, driven by fear and hope, reading yesterday's news and acting on tips. Their activity creates noise, not direction. The composite operator, and by this I mean the large institutional interests, the banking houses, the professional syndicates who operate with inside knowledge and substantial capital, these interests move differently. When they accumulate or distribute positions, volume expands. It must expand. You cannot move 10,000 shares, 50,000 shares, 100,000 shares without leaving footprints in the volume record. Consider a support level that has held 3 times. On the first test, volume was moderate. On the second test, volume was light, perhaps only the public selling in panic while professionals remained patient. But on the third test, volume surges to twice the daily average and price holds firm, even advancing by the close. What does this tell us? The composite operator has stepped in. They are absorbing supply. They are building a line, accumulating inventory from weak hands at favorable prices. Now contrast this with resistance. A stock approaches overhead supply at a previous high. The first test sees heavy volume and rejection. Distribution is occurring. Professionals are selling to the eager public. The second test produces similar volume, but less price progress. The third test shows diminishing volume. Supply is becoming exhausted. The professionals have completed their distribution, and now only amateur sellers remain, trading on emotion rather than position. This is why I have always maintained that the tape tells all. Price action alone can deceive you. A sharp move can occur on minimal volume, a shakeout orchestrated to trigger stop losses and frighten weak holders. But when you combine price with volume, the composite operator reveals his hand. High volume at support means accumulation is underway. High volume at resistance means distribution is occurring. Low volume at these levels means the professionals are absent, they're not interested at these prices, and you shouldn't be either. The amateur looks at a chart and sees lines. The professional looks at the same chart and sees campaigns, periods of accumulation where the operator quietly builds position, periods of markup where public participation increases, periods of distribution where the operator transfers his holdings to the eager crowd, and periods of markdown where the remaining holders suffer losses. Volume is your window into these campaigns. It shows you when the operator is present and when he is not. It reveals whether support and resistance levels have true institutional backing or are merely technical artifacts that will crumble under pressure. Master the reading of volume, and you gain the ability to align your speculation with the most powerful forces in the market, rather than standing opposed to them, which is where most traders find themselves wondering why their carefully drawn support lines failed to hold. There is a phenomenon that occurs in the stock market with such regularity that it might as well be considered a natural law, yet the majority of speculators fail to recognize it, even when it unfolds directly before their eyes. I am speaking of the diminishing volume pattern at resistance, a signal so clear, so unmistakable, that once you train yourself to see it, you will wonder how you ever traded without this knowledge. Picture a stock that has rallied from 40 to 50, where it encounters resistance. The first approach to 50 sees substantial volume, perhaps 3 million shares, and prices turn back. The sellers at this level are numerous and aggressive. Supply overwhelms demand, and the stock retreats. This is normal. This is expected. The operator who accumulated below is now testing the waters to see how much supply exists at these higher levels. The untrained trader sees this rejection and concludes that 50 is an impenetrable barrier. He marks his chart, draws his line, and prepares to short the next rally to this level. This is his first mistake. Now watch what happens on the second approach. The stock rallies back to 50, but this time volume is only 2 million shares. Price is again rejected, but the rejection is less emphatic. Perhaps the stock closes nearer to 50 than it did on the first test. What has occurred here? Simple. Some of the sellers who were present the first time have completed their selling. Supply has diminished. The composite operator notes this carefully. On the third test, volume drops to 5 million shares. The rejection is weaker still. The stock may even penetrate 50 briefly before settling back. By the fourth test, volume has declined to 1 million shares, less than 1/3 of the volume seen on the first approach. The amateur, still waiting to short, cannot understand why the stock refuses to collapse as it should. He does not realize he is witnessing the exhaustion of supply. This pattern tells us something critical. The sellers who created the resistance at 50 are not an infinite pool. They are a finite group, and with each test, more of them complete their selling and step aside. The dwindling volume is not a sign of disinterest. It is a sign that the opposition is melting away. The path is being cleared. When the fifth or sixth test arrives on volume even lighter than before, and price suddenly surges through 50 on expanding volume, the amateur is caught completely off guard. He believed the line would hold forever. He did not understand that resistance is not a wall. It is a pocket of supply that can be, and regularly is, exhausted through repeated testing. This is why I have always taught that the skillful tape reader must compare each test of resistance to previous tests. It is not the absolute level of volume that matters most. It is the relationship between successive tests. Declining volume at resistance is the market's way of telling you that the sellers are losing their grip, that their ammunition is running low, that the composite operator is succeeding in his campaign to absorb all available supply before the markup phase begins. The crowd sees repeated rejection and assumes weakness. The professional sees diminishing volume and recognizes exhaustion. He knows that when supply dries up at resistance and demand finally enters with force, the resulting advance can be explosive. This is not hope. This is observation. This is reading the tape correctly. And this is why the professional profits while the amateur, still waiting for his short signal at resistance, watches in confusion as the stock runs away to 60, then 70, wondering what happened to that strong resistance at 50. The answer was in the volume all along. I have spent decades studying the behavior of stocks, and if there is one principle I could impress upon every speculator, it would be this: support is not merely a price level where a stock has previously bounced. It is a battleground where organized buying power demonstrates its willingness and ability to overwhelm selling pressure. Without volume confirmation, your support level is nothing more than a hopeful line drawn on paper. Let me illustrate this with absolute clarity. A stock declines from 60 to 50, where it finds support and rallies. Some weeks later, it declines again to 50 and once more rallies. The amateur marks 50 as support and considers his analysis complete. He has identified a level, and he believes this gives him an edge. It does not. What he has identified is merely a price. He has not determined whether there is genuine buying power defending that price. Now observe what the professional does. He watches the first test of support at 50 and notes the volume, perhaps 5 million shares traded that day. The stock rallied, yes, but on what conviction? He reserves judgment. When the second test arrives, he leans forward and studies the tape with intensity. If volume comes in at 2 million shares lighter than the first test, he becomes skeptical. The support may hold temporarily, but it lacks the backing of serious buying interest. The composite operator is not present in size. But suppose something different occurs. The second test of 50 sees volume expand to 5 million shares, nearly double the first test. Furthermore, the stock does not simply bounce weakly from 50, it closes in the upper portion of the day's range, showing that buyers were aggressive, willing to pay higher prices as the day progressed. This, my friend, is confirmation. This tells you that institutional interests are defending this level, that they view 50 as an attractive price to accumulate inventory. The third test becomes even more revealing. If volume expands again, perhaps to 3 million shares or more, and the stock closes strongly, you are witnessing a campaign of accumulation. The composite operator is using these declines to 50 as opportunities to build a substantial line. He is absorbing all the supply that frightened holders and weak speculators are willing to offer at these prices. This is not hope. This is not wishful thinking. This is evidence, recorded in the permanent record of the tape, that powerful buying interests are present and active. Here is what separates the professional from the amateur. The professional understands that support without volume is an illusion. A stock can bounce from a level several times on light volume, giving the appearance of strength, only to collapse through that level when genuine selling pressure arrives. Why? Because there were no significant buyers defending it, only the random fluctuations of public trading, the small orders of timid speculators who buy 100 shares here, 200 there, with no conviction and no capital to sustain their positions when fear takes hold. Expanding volume at support proves that the composite operator has made a decision. He has surveyed the landscape, analyzed the fundamentals, positioned his capital, and now he is acting. When you see volume surge as price test support, you are witnessing the absorption of supply by interests that have both the knowledge and the resources to conduct a campaign. These are the players you want to align yourself with, not because you know what they know, but because their actions speak louder than any inside information ever could. Mark this well: a support level confirmed by expanding volume is a fortress. A support level held on diminishing volume is a house of cards. Learn to distinguish between the two, and you will save yourself from countless false signals and painful losses. The tape does not lie, but you must learn to read what it is telling you. Of all the tactical maneuvers employed by the composite operator, none is more calculated, more effective, or more misunderstood than what I call the spring. This is the deliberate violation of support, a false breakdown engineered to shake out weak holders and create the precise conditions the operator needs before launching a substantial markup campaign. If you do not understand the spring, you will be victimized by it repeatedly. If you learn to recognize it, you will find some of your most profitable opportunities. Let me describe how this unfolds, for I have witnessed this pattern countless times across every market and every era. A stock has been building a base of support at 45. Multiple tests have occurred, volume has confirmed buying interest, and accumulation appears to be underway. The public, observing this support, begins to buy, they place their stop-loss orders just below 45, at 44.50, at 44, believing they are protecting themselves from loss. This is their fatal error. The composite operator knows exactly where these stops are clustered. He has been accumulating inventory at 45, but he wants more, much more, and he wants it at even better prices, so he orchestrates a spring. On a day of seemingly bearish news, or perhaps on no news at all, he drives the price down through 45 on increased volume. The break is sharp, emphatic. It triggers every stop-loss order below 45. Panic grips the weak holders. They sell in fear, certain that support has failed and a collapse is imminent. Here is where you must watch with the keenest attention. The stock drops to 43. 50, perhaps even 43, and volume spikes dramatically, 2 or 3 times the recent average. The crowd sees this heavy volume and interprets it as massive distribution, as confirmation that the professionals are dumping their holdings. They could not be more wrong. That heavy volume represents the composite operator absorbing every share that frightened sellers are throwing at him. He is buying their panic. Now observe what happens next. Within hours, sometimes within the same trading session, the stock reverses. It climbs back above 45, the very support level that was supposedly broken, and it does so on expanding volume that exceeds even the breakdown. By the close, the stock might finish at 46 or 47, leaving a long lower shadow on the chart, a testament to the false breakdown. This is the signature of the spring. What has the operator accomplished? He has shaken out every weak holder, every trader with poorly placed stops, every speculator who lacked conviction. He has acquired their shares at 43 to 44, better prices than he could have obtained if support had simply held. He has cleared the deck of potential sellers who would have exited on the first sign of trouble during the subsequent rally. Most importantly, he has completed his accumulation and is now ready to begin the markup phase with maximum control over the floating supply. The spring is recognizable by 3 characteristics. First, the penetration of support on increased volume. Second, the rapid reversal back above support, typically within 1 to 3 days. Third, the expanding volume on the upswing that confirms buying power, overwhelming the attempted breakdown. When you see these elements align, you are witnessing not a failure of support, but rather its most powerful confirmation. The final shakeout before a significant advance. I cannot overstate the importance of this pattern. The amateur sees the break of support and sells, often at the very bottom. The professional sees the spring, recognizes the operator's hand, and positions himself for the coming campaign. One loses capital and confidence, the other captures the entire subsequent move. The difference is not luck, it is knowledge. It is the ability to read the tape and understand that the composite operator must sometimes appear to break support in order to complete his accumulation under optimal conditions. Remember this, the most profitable moves often begin with the most painful action. The spring is that pain, deliberately inflicted, carefully calculated, and ultimately your greatest opportunity if you have the knowledge to recognize it. I must now address one of the most dangerous illusions in speculative markets, the low-volume breakout. This phenomenon has separated more amateurs from their capital than perhaps any other technical pattern, and yet it continues to deceive traders generation after generation. Let me state this plainly. A breakout through resistance on major volume is not an opportunity, it is a warning. It is the market telling you, in the clearest possible terms, that what you are witnessing lacks institutional support and will almost certainly fail. Consider the mechanics of what must occur for a genuine breakout to succeed. A stock has been confined below resistance at 50 for weeks or months. Above 50 lies a zone of supply, shareholders who bought at higher prices and have been waiting for an opportunity to sell at break-even or at a small loss. These are not weak holders who can be easily frightened. They are patient sellers with specific price targets. For the stock to break through 50 and sustain that breakout, there must be sufficient demand to absorb all of this overhead supply. This requires capital, substantial capital, and when substantial capital enters the market, it leaves unmistakable footprints in the form of volume. Now observe what happens when a stock breaks above 50 on volume of only 800,000 shares, barely above its daily average, perhaps even below it. The amateur sees the breakout on his chart and immediately buys, excited that he has caught the beginning of a new trend. He does not pause to ask the critical question, where is the buying power? Who is driving this advance? The answer, more often than not, is nobody of consequence. What you are witnessing is either a technical squeeze, a brief surge as short sellers cover positions, or the random fluctuations of public trading. There is no composite operator behind this move. There is no institutional accumulation campaign reaching its culmination. There is only the hope of the crowd, expressed in insufficient volume. Within days, sometimes within hours, the stock retreats back below 50. The overhead supply that the amateur forgot about reasserts itself. Sellers who have waited patiently for 50 now unload their shares, and there are no substantial buyers to absorb this supply. The stock not only fails to hold the breakout, it often declines sharply, punishing everyone who bought the false signal. The amateur, confused and demoralized, attributes his loss to bad luck or poor timing. He does not recognize that the tape told him exactly what would happen if only he had learned to read it. Contrast this with a genuine breakout. The stock approaches 50 and then surges through it on volume of 5 million shares, 3 times the daily average. This volume tells you something critical. The composite operator is present and committed. He is willing to absorb all the overhead supply, to pay up for shares, to use his capital aggressively to drive price through resistance. This is not hope, this is force. This is the kind of buying power that can sustain an advance. I have developed a simple rule through decades of observation. If a breakout through significant resistance does not occur on at least double the average daily volume, I treat it with skepticism. If it occurs on triple the average volume, accompanied by a close in the upper portion of the day's range, I recognize it as genuine. The difference between these two scenarios is the difference between a trap and an opportunity. The crowd chases breakouts indiscriminately, attracted by the visual appearance of price moving through a key level. The professional examines the volume behind the breakout and asks whether sufficient buying power exists to overcome the natural resistance that lies ahead. One approach leads to repeated losses and frustration. The other leads to alignment with the most powerful moves in the market. Learn to demand volume confirmation before you trust a breakout. Make it your standard, your filter, your protection against the countless false signals that the market generates. When you see price move through resistance on thin volume, do not celebrate, be suspicious. Wait for the inevitable failure, and if anything, consider taking the opposite side of the trade. But when you see genuine volume, when you see the unmistakable footprints of institutional buying, then you have found what every speculator seeks, a high-probability opportunity backed by real force, real capital, and real commitment. The tape does not lie about breakouts. It tells you immediately whether they are genuine or false. Your only task is to learn its language. I have observed, throughout my career, that the greatest errors in speculation arise not from a lack of information, but from a misinterpretation of information. Nowhere is this more evident than in the reading of volume. The amateur looks at volume as an absolute figure. He sees 2 million shares traded and judges this as high or low, based on some arbitrary standard or general impression. The professional understands that volume is meaningless without context, and the most important context is the volume history at that specific price level during previous tests. Let me make this principle concrete with an illustration from actual market observation. A stock tests resistance at 55, and on that day, volume registers 3 million shares. The amateur observes this and thinks, 3 million shares, that's substantial volume. This resistance is strong. He marks his chart accordingly and prepares his trading strategy based on this conclusion. He has made a critical error. The professional approaches the same situation with a different questions. What was the volume on the previous tests of 55? He reviews his records and discovers that the first test of 55, which occurred 3 weeks earlier, saw volume of 7 million shares. The second test 2 weeks ago showed volume of 5 million shares. Now, on this third test, volume has declined to 3 million shares. The absolute figure of 3 million shares, which appeared substantial to the amateur, is revealed in proper context as a dramatic decrease in selling pressure. Supply is being exhausted. The resistance is not strengthening, it is weakening. This comparative analysis is not optional, it is essential. The market operates through cycles of supply and demand, and these cycles reveal themselves through the changing volume characteristics at specific price levels. When a support or resistance zone is first established, the volume tells you how much conviction exists at that price. When the same zone is tested again, the comparative volume tells you whether that conviction is increasing, stable, or diminishing. Consider another scenario. A stock finds support at 40 on volume of 2 million shares. The next test of 40 shows volume of 2 million shares, slightly higher. The third test brings volume of 8 million shares. The fourth test sees volume surge to 4 million shares. What story is this volume telling? It is telling you that buying interest at 40 is intensifying with each test. More buyers are entering, more capital is being deployed, more conviction is building. This is not merely support, this is accumulation gathering momentum. The composite operator is increasing his commitment to this price level with each opportunity to buy. The reverse pattern is equally instructive. If support at 40 is first established on 4 million shares, then tested on the 3 million shares, then 2 million shares, you are witnessing the dissipation of buying power. The buyers who defended 40 initially are either satisfied with their positions or losing their conviction. When the next test arrives on even lighter volume, you should expect that support to fail, because the buying power that created it has evaporated. I cannot emphasize strongly enough that volume must always be evaluated relative to previous volume at the same price level. A breakout on high volume means nothing if previous tests showed even higher volume. A support level holding on adequate volume is concerning if previous tests showed much stronger volume. The tape is speaking to you in relative terms, not absolute terms, and until you train yourself to think comparatively, you will misread its message consistently. This is why I have always advocated maintaining careful records. You cannot compare today's volume to last week's volume if you have not recorded last week's volume. You cannot recognize a pattern of increasing or decreasing participation if you are not tracking the progression. The professional keeps meticulous notes, not because he enjoys paperwork, but because these notes provide the context that transforms raw data into actionable intelligence. When you approach a support or resistance test, your first question should never be, is this high volume or low volume? Your first question should be, how does this volume compare to the previous tests of this level? That single question, properly answered, will tell you whether the force behind the price level is growing stronger or weaker. It will tell you whether to trust the level or suspect it. It will tell you whether the composite operator is increasing his commitment or backing away. I have observed throughout my career that the greatest errors in speculation arise not from a lack of information, but from a misinterpretation of information. Nowhere is this more evident than in the reading of volume. The amateur looks at volume as an absolute figure. He sees 2 million shares traded and judges this as high or low based on some arbitrary standard or general impression. The professional understands that volume is meaningless without context, and the most important context is the volume history at that specific price level during previous tests. Let me make this principle concrete with an illustration from actual market observation. A stock tests resistance at 55, and on that day, volume registers 3 million shares. The amateur observes this and thinks 3 million shares, that's substantial volume. This resistance is strong. He marks his chart accordingly and prepares his trading strategy based on this conclusion. He has made a critical error. The professional approaches the same situation with a different question. What was the volume on the previous tests of 55? He reviews his records and discovers that the first test of 55, which occurred 3 weeks earlier, saw volume of 7 million shares. The second test 2 weeks ago showed volume of 5 million shares. Now on this third test, volume has declined to 3 million shares. The absolute figure of 3 million shares, which appeared substantial to the amateur, is revealed in proper context as a dramatic decrease in selling pressure. Supply is being exhausted. The resistance is not strengthening, it is weakening. This comparative analysis is not optional, it is essential. The market operates through cycles of supply and demand, and these cycles reveal themselves through the changing volume characteristics at specific price levels. When a support or resistance zone is first established, the volume tells you how much conviction exists at that price. When the same zone is tested again, the comparative volume tells you whether that conviction is increasing, stable, or diminishing. Consider another scenario. A stock finds support at 40 on volume of 2 million shares. The next test of 40 shows volume of 2 million shares, slightly higher. The third test brings volume of 8 million shares. The fourth test sees volume surge to 4 million shares. What story is this volume telling? It is telling you that buying interest at 40 is intensifying with each test. More buyers are entering, more capital is being deployed, more conviction is building. This is not merely support, this is accumulation gathering momentum. The composite operator is increasing his commitment to this price level with each opportunity to buy. The reverse pattern is equally instructive. If support at 40 is first established on 4 million shares, then tested on the 3 million shares, then 2 million shares, you are witnessing the dissipation of buying power. The buyers who defended 40 initially are either satisfied with their positions or losing their conviction. When the next test arrives on even lighter volume, you should expect that support to fail, because the buying power that created it has evaporated. I cannot emphasize strongly enough that volume must always be evaluated relative to previous volume at the same price level. A breakout on high volume means nothing if previous tests showed even higher volume. A support level holding on adequate volume is concerning if previous tests showed much stronger volume. The tape is speaking to you in relative terms, not absolute terms, and until you train yourself to think comparatively, you will misread its message consistently. This is why I have always advocated maintaining careful records. You cannot compare today's volume to last week's volume if you have not recorded last week's volume. You cannot recognize a pattern of increasing or decreasing participation if you are not tracking the progression. The professional keeps meticulous notes, not because he enjoys paperwork, but because these notes provide the context that transforms raw data into actionable intelligence. When you approach a support or resistance test, your first question should never be, is this high volume or low volume? Your first question should be, how does this volume compare to the previous tests of this level? That single question, properly answered, will tell you whether the force behind the price level is growing stronger or weaker. It will tell you whether to trust the level or suspect it. It will tell you whether the composite operator is increasing his commitment or backing away. Context is everything. A number without comparison is just a number. A number placed in its proper historical context becomes evidence. Evidence of accumulation or distribution, of strengthening conviction or fading interest, of an opportunity developing or a trap being set. Learn to read volume comparatively, and you will understand what the market is truly telling you at each critical juncture. The tape reveals all, but only to those who know how to read it properly. Gentlemen, we have covered considerable ground today, but let me distill these principles into their essence so you may carry them forward into your own operations. The market is not a mystery, nor is it governed by chance or chaos. It is a battlefield where capital changes hands, from the uninformed to the informed, from the weak to the strong, from those who react emotionally to those who act on evidence. Volume is the language through which this battlefield communicates its intentions, and support and resistance are the strategic positions where the crucial engagements occur. You have learned that volume reveals institutional intent, that the composite operator cannot move substantial capital without leaving footprints in the record. You have learned that diminishing volume at resistance signals the exhaustion of supply, that expanding volume at support confirms organized buying power, and that the spring represents the operator's final shakeout before a major campaign. You have learned that low-volume breakouts are traps set for the unwary, and that all volume must be evaluated comparatively in the context of previous tests at the same price level. But knowledge alone accomplishes nothing. These principles must be applied, practiced, and refined through actual observation of the market. You must train your eye to see these patterns as they develop, not merely in hindsight but in real time, when decisions must be made and capital must be committed or withheld. I urge you to begin tonight. Review your charts, not casually, but systematically. Identify every support and resistance level that has formed over the past months. Examine the volume at each test. Compare the first test to the second to the third. Ask yourself what story the volume is telling. Is buying power increasing or decreasing? Is supply being exhausted or replenished? What would you conclude about the intentions of the composite operator? Do this exercise with at least 20 stocks across different industries and price ranges. Record your observations. Note the patterns that emerge. Within weeks, you will begin to see what was previously invisible. The tape will start speaking to you in a language you understand. The seemingly random fluctuations of price will resolve into comprehensible campaigns of accumulation, markup, distribution, and markdown. Remember this above all: the composite operator succeeds because he operates on knowledge, while the public operates on emotion and hope. He studies the tape, he reads the volume, he understands the dynamics of supply and demand at every price level. He is patient, disciplined, and systematic. He does not gamble, he campaigns. You can align yourself with these powerful interests, or you can stand in opposition to them. The choice is yours, but the outcome is predetermined. Those who learn to read the tape, who understand volume's testimony about institutional intent, who recognize the patterns of accumulation and distribution, these individuals will find themselves on the winning side of the most significant moves. Those who ignore these principles will continue to buy at the wrong time, sell at the wrong time, and wonder why success remains elusive. The market rewards those who see clearly and act decisively based on evidence rather than emotion. It punishes those who guess, hope, and react impulsively to price movements without understanding the forces behind them. I have given you the tools. The tape is available to everyone, rich and poor alike. The volume record is public, transparent, and honest. It does not deceive. It does not manipulate. It simply reports what has occurred. Your task now is to learn its language, to read its message, and to act accordingly. Go forth and study, observe, record, compare, think, and above all, align your speculation with the evidence the market provides rather than with your wishes or fears. Do this consistently, and you will find that success in speculation is not a matter of luck or mystery. It is a matter of knowledge, discipline, and the willingness to see what is actually occurring rather than what you hope or fear is occurring. The tape tells all. Learn to read it, and you will have an advantage that no tip, no rumor, no inside information can match. For while tips may be false and rumors may mislead, the tape records the actual movement of capital, and capital, ultimately, is truth. I thank you for your attention, and I wish you success in your future operations.